Into agriculture today, and we continue our domestic and international grain market conversation with Dan O'Brien and Guy Allen. And as we continue this conversation, gentlemen, what is soybeans looking like?
Well, on the domestic side, we have a balance sheet that actually grew some in terms of ending stocks. There was a 35 million bushel reduction in projected U.S. soybean exports down to 1.722 billion bushels, and a little bit trading back and forth and seed and residual, a million bushels here and there. Total use, again, dropped by that 35. Ending stocks increased by that 35 million up to 315. So the stocks to use figure now is 7.6%. And just quickly, Guy, because I know we're going to take a look at this on the soybean oil side, there were no changes in soybean oil biofuel usage. Again, 13 billion pounds, but the trend is sure strong from 10.4 to 12.5 to 13 now. We're continuing to step that up year by year in these marketing years. And Guy, I really think that there were no changes really in the domestic U.S. side, but what would change the domestic U.S. balance sheet would be response to maybe what would happen internationally. So you want to take that over?
Yeah, just one point to make domestically. We've got a record crush number out there in the U.S. balance sheet. So we're sitting very strong, historically high crush demand, and that's being driven by that biofuels and we're seeing it in soybean oil. Just to comment on the soybean oil, last year we had about as many imports as we did exports. This year, the U.S. is sort of forecast to be a net importer of vegetable oil of about 70,000 metric tons. That's sort of a change in dynamics a bit, and that increased demand for crush is coming off exports one for one. Shifting a bit now to look at the export and international markets. Exports for U.S. soybeans really is the darkest spot, I'd say, in the whole commodity complex. We're at the lowest level in 4 years, and soybeans exports historically about 60% of their production. It's a big chunk. So they really rely on that export market. USDA had demand down by 35 million bushels, and that's 272 million bushels less than 23 just last year. So that export market's real tough.
And if I could add in on that too, that when you look at the trends in crush, which is moderately higher, the trend in exports more sharply lower, we're certainly, we sure seem to be transitioning our soybean usage, soybean demand side of the ledger more towards domestic biofuel production. That's just the reality of it.
Just to shift discussion now to the biggest soybean exporter and producer down to South America and Brazil. They sort of left those numbers unchanged. Not too much of interest there. One thing I point out, a couple of weeks ago, we did have a couple boats of Brazilian soybeans trade into the East Coast. They haven't necessarily been executed yet, but that really sort of put a cap on soybean prices when those price relationships on that. We saw Brazilian soybeans drop nearly $70 a metric ton in a couple-day period 2 weeks ago. The Argentine crop, on Brazil, they did reduce Brazilian crop by 1 million metric tons to 156. CONAB, though, has that at 149. That's about a 7 million metric ton difference on that. Dan, did you want to talk to that dichotomy there a bit?
Well, I think the USDA is being cautious in terms of how they deal with changes. I guess I think that again, the truth may be in the middle, or the truth may be lower, because I've seen some lower estimates also. But what it does, I think it just kind of punts forward, having to put a hard number on what dry conditions may have done down in Brazil, and so it puts the onus on the March, April, and May reports to kind of finally arrive at what that final number is, and how it may affect the U.S., well, the world supply demand situation. And if that happens, it comes back and lends support to U.S. exports, tightens up our balance sheet. But if that were to happen, it's probably happen around planting time in the U.S.
Yeah.
So
Well, no, exactly. As we looked at China, they have China, their near record imports of 102 million metric tons. And they're starting to shift their purchasing activity now from the US, mainly coming off the PNW down to Brazil. And as you say, that generally shifts in March as we see South American harvest start to come off. Not and they got Chinese crush projected at 98 million metric tons, which is fairly strong. However, the big driver of that in China is, as we talked on the corn, is the pig numbers and that feed demand. And I think, that's going to be the telling factor, and we'll see how that plays out. The crush margins in China have not been real strong, and it's just even the Southeast Asia imports, they reduced by 500,000 metric tons, now just below 10. So that's the big unknown. I think that in soybeans particularly, but also we're seeing that in corn as well.
I guess I just add one thing in, Guy, for your response. When you look at almost all the seasonal price patterns that we have for these commodities, we come into February and we tend to not have a lot of volatility, and we tend to move here in the U.S. domestically for prices. We move into March, April, May, we tend to have more. So with these numbers now on the U.S. side, it doesn't look like we're anticipating anything being challenged unless just the cash market says, "Hey, we can't get stuff." It doesn't. So this report kind of sets us up. I think unless there's a surprise in South America, for prices to go pretty much sideways to maybe slightly higher, hopefully in the next 1 or 2 months, but then in the spring to actually have to deal with these South American issues.
Yeah. Look, the big wild card, I think, in South America is Argentina, given the political situation down there. You've got a new president, Milei, who's trying to institute some changes. Congress is controlled by the other political party. It'll be interesting how they can do that. They did even up the export tax. So it's going to change the dynamics of oil seeds coming out of Argentina. But how that plays itself out, particularly in the environment of near hyperinflation that they have down there, over 200% a year, is going to have an impact.
And as we're
And a day ago, I saw within almost 1 minute of each other one report that said, "Oh, dry conditions are really going to harm the Argentine crop," and then right afterwards, "Oh, abundant rainfall will just save the day." So we don't know, and maybe that's the fog of market news that's coming out.
Yeah, just on Argentina, if we shift to the geopolitical issues and that, it's look, we're talk about the shipping. We've seen fairly steady dry bulk index values for commodities over the last 30 days. It's come off since the first of the year, so that's a good signal, particularly in the wake of the conflict areas in the Suez, Red Sea, and Straits of Hormuz there. Good news coming out of Panama. They have had some rain down there, which is raising water levels, and expected to raise water levels into the spring months. And as the water comes up, that alleviates. And just go back a little further, the Mississippi sort of sorted itself out. It's amazing what a little rain will solve a lot of problems everywhere, won't it? The other thing we always like to touch base on is the value of the U.S. dollar. It's been down in the last few days on that dollar index, but it's still at about a 90-day high. And that higher dollar value, particularly for the people buying our ag commodities, is making our commodities very, very expensive. And so cheaper sources in other locations really has an advantage as the U.S. becomes basically the seller of last resort across a number of these commodities.
So as we round out today's conversation, as we've been talking about the World Agricultural Supply and Demand Estimates report that came out this Thursday on the 8th, how would you guys respectively, internationally and domestically, how is the grain market doing in your perspective?
Good, Guy.
Well, depends whether you're a Kansas or Illinois farmer or an international buyer. Look, the prices have come down a bit. We should be pricing in some demand, particularly in the international sector, but we really haven't seen that come to town yet. With these lower values and input prices remaining fairly strong, it's just really squeezing the margins as that grower is getting ready to go to the field and plant this next season crop. So it's going to present some real challenges from the farm gate perspective in merchandising or in locking in those production margins.
and in financial management. You know, and it is interesting in the midst of all that we're hearing, you hear of major farm financial problems down in Brazil, and I'm not sure what that is. You know, it is that dryness in pockets, inflation in costs. There's something going on, and talking to farmer groups here in the last day there. So even this week here in Kansas. Lenders, farmers are concerned at how low prices compared to their cost of production. Generally, the idea is that you look at our budgets, so the cash prices we have now cover direct costs for the most part. But when you start adding in then machinery and land costs and family living on top of that, that's really the challenge. So how are we doing? We have low prices. We're enduring February, and I wonder seasonally where we'll be. I'm still mindful of what Chip Redman and other university climatologists have talked about in terms of weather risks this summer, but those things are not on the mind of the market right now. So I guess we'll deal with them when we get there, but we're sort of myopic and not really pricing in seasonal volatility on the futures anyway, in my view at this point.
Dan, Guy, I appreciate you both taking the time to join us today and give us our grain market update.
Thank you very much.
That was K-State grain economist Dan O'Brien, and he was joined by the senior economist from the IGP Institute at K-State, Guy Allen. I will link the recent WASDE report in today's show notes on agtoday.net. We're cutting to a short break now, but we'll be back with more ahead.